Hello students, welcome to the lecture on Depreciation Accounting, and after the lecture we will be able to learn the following objectives. Explain meaning of depreciation and its causes, understand objectives of providing depreciation, discuss factors affecting depreciation, explain accounting treatment including provision for depreciation accounting, explain methods of depreciation. Let us start with the introduction to depreciation. Depreciation has a significant effect in determining and presenting the financial position and results of operations of an enterprise. Depreciation is charged in each accounting period by reference to the extent of the depreciable amount, irrespective of an increase in the market value of the assets. Assessment of depreciation and the amount to be charged in respect thereof in an accounting period are usually based on the following three factors: historical cost or other amount substituted for the historical cost of the depreciable asset when the asset has been revalued, expected useful life of the depreciable asset, and estimated residual value of the depreciable asset. Depreciation is a reduction in the value of a product arising from the passage of time due to use or abuse, wear and tear. Depreciation is not a method of valuation but of cost allocation. This cost allocation can be based on a number of factors, but it is always related to the estimated period of time the product can generate revenues for the company, economic life. Depreciation expense is the amount of cost allocation within an accounting period. Only items that lose useful value over time can be depreciated. Land cannot be depreciated because it can always be used for a purpose.
Depreciation. Definition 1. The recognition of part of an asset's cost as an expense during each year of its useful life. This expense can be calculated either by straight-line depreciation, the same dollar amount is assigned to each year, or by one of several accelerated methods in which the dollar amounts are weighted and/or accumulative. Definition 2. Any loss in value, whether due to market changes or wear and tear over time. Unless you are working in an accounting office, this is the meaning you will most often come across. Examples. There was so much depreciation on the car in its first year that it wasn't worth trading in for a newer model.
Meaning of depreciation. Students, what is depreciation? For accounting purposes, depreciation indicates how much of an asset's value has been used up. For tax purposes, businesses can deduct the cost of the tangible assets they purchase as business expenses. However, businesses must depreciate these assets in accordance with IRS rules about how and when the deduction may be taken, based on what the asset is and how long it will last. Depreciation is used in accounting to try to match the expense of an asset to the income that the asset helps the company earn. Most businesses need to purchase some kind of durable equipment in order to operate. Equipment that lasts longer than 1 year is called a fixed asset. These assets assist in the generation of revenue over time. For instance, an oven that lasts several years may be used to bake many loaves of bread each day. The oven is integral to the sale of each loaf of bread. Property such as ovens, furniture, computers, vehicles, and buildings contribute to the operating capacity of a company over many years. Because of this long-term contribution, fixed assets are treated differently than many other business expenses. The purchase price of these fixed assets is typically expensed over a period of years rather than in the year the purchase was made. This business expense is known as depreciation. Depreciation can be understood in three ways. Popular definition: a decline in the market value of an asset due to wear and tear, obsolescence. A new automobile depreciates. Tax definition: a way to recover the cost of a fixed asset through tax deductions. Like other business expenses, depreciation expenses reduce a taxable income. Accounting definition: a means of allocating a portion of a fixed asset's cost to each period that the asset helps generate revenue. Partial year's depreciation. It is imprecise to take a full year's depreciation when an asset has only been in service for part of a year. When a fixed asset is acquired or disposed of mid-year, the full year depreciation amount is prorated according to the amount of time the asset has been in service. There are several simplified conventions used to do this. The convention chooses effects the amount of a depreciation in the first and last accounting periods.
Depreciation applies to fixed assets on your balance sheet. This group of assets is also called property, plant, and equipment, or PP&E for short. They are items that you buy to use in your business to help generate income for more than 12 months. Examples of fixed assets include land and buildings, plant and equipment, furniture, fixtures and fittings, computers, motor vehicles, trucks, and so on. The word fixed doesn't mean that they're not physically movable. It means they are part of your long-term business assets. That's why they fall in the non-current assets part of your balance sheet. Whether an item is a fixed asset or not depends on what it's used for in the business. For example, a car dealership buys and sells cars to generate income. These cars are bought by the business for the purpose of selling them as quickly as possible at a profit, so they are part of the business's stock or inventory. The dealership would also have its own cars for use by the business. These cars would be part of the business's fixed assets. It's the business purpose of the item that determines whether it's part of inventory or fixed assets. All fixed assets have finite useful lives. Land is the exception. Depreciation is an accounting concept which spreads the cost of a fixed asset over the term of that asset's useful life. The length of the useful life depends on the asset. For a computer, it might be 3 years, a bottling line, 8 years, a building, maybe 20 years. The reason for spreading the fixed assets cost is to match expense with income. A car or a computer or a building will be used in the business to generate income for more than 1 year. In other words, the cost is an expense that's related to future income in your business, so it shouldn't just be expensed in the month that you buy it. Imagine what it would do to your business profit if you charge the entire cost of a factory as an expense in 1 month. There are various ways for spreading the cost over the useful life. You could use the straight line method, the declining balance method, or the units of production approach. These are just 3 examples out of a range of possible bases of depreciation. Each method spreads the depreciation expense out in a different pattern over the years of useful life. Tax and accounting rules set out what the useful life of an asset is and the appropriate basis of calculating depreciation. Your accountant will know what applies to your business's fixed assets. Let's use a car as an example to see the effect of depreciation on your financials. I'm going to use a simple balance sheet so that we can focus only on fixed assets, that's the car, and depreciation. Let's say the business already has $4,000 in cash, and that cash came in by way of capital you put in. Your business buys the car for use in the business on the first day of January. The car costs $4,000. The car will show up in your balance sheet under fixed assets. In your cash flow statement, the cash flows for that first day of January will show the purchase of the car as capital expenditure under investment activities. Now, a car can't just magically appear on your balance sheet. The next question is, how did the business pay for it? Well, you could use that cash on hand, but that would mean you run your cash balances down to 0. Alternatively, you could do it by way of a financing facility from the bank. That means you'd have cash inflow from the bank loan and bank borrowings as a liability on balance sheet. Net cash flow as a result of the purchase of the car would then be 0. Or maybe you as a shareholder could make a loan of $4,000 to the business to buy the car. In this case, your cash flow statement would show cash inflow from a loan from shareholders, and you'd see that loan as a liability on the balance sheet. For the purposes of this exercise, let's assume that you as a shareholder lend the money to the business. This way, we don't run the business cash balances down to 0, and we also don't incur bank debt. Let's say the car has a useful life of 4 years for accounting and tax purposes. It's expected to have no value left at the end of 4 years. So that means it will depreciate or reduce in value by $1,000 a year, assuming we use what is known as straight line depreciation. This basis of depreciation simply means that the cost of the asset is depreciated in equal amounts over its useful life. So in this instance, the value of the car in your accounts will be reduced by $1,000 a year, and by the end of year 4, it's worth 0 in your accounts. Your business still has the car at the end of year 4, even though it has 0 value on the books. So how does an investment in a fixed asset like a car and its associated depreciation affect your financials? Here's a profit and loss with some simple sales and expense numbers. I'm holding these numbers constant across the period so that we can focus on depreciation. We're also going to ignore income tax for the purposes of this exercise. Depreciation expense is a way of allocating the cost of the car over its useful life. So in this example, we have annual depreciation expense of $1,000 in your profit and loss for 4 years. Over these 4 years, your business has to be able to produce enough income through using the car that will more than cover its costs. In other words, it has to generate a return on investment, or ROI. If you're still using the car in year 5, there's no depreciation expense because the car is already fully depreciated. You've fully expensed its original cost. So does that mean it's zero cost to your business to keep using the car? It depends on the condition of the car. Is it at the point where repairs and maintenance are starting to escalate? Let's assume that repairs and maintenance costs stay the same as in previous years. Does the fact that you now have $0 depreciation expense in year 5 mean that your business is suddenly more profitable? It depends on what measure of profit you're looking at. There would be no difference if you're looking at a profit measure called EBITDA. That's earnings before interest, tax, depreciation, and amortization.
Let's study the causes of depreciation. Lifespan of an asset to a business rests primarily on the purpose of its acquisition and secondary on its nature. An item acquired for immediate consumption or sale is a short-lived asset, and that meant for prolonged use is a long-lived asset, though both produce revenues. Whereas the former asset expires within 1 year of its acquisition, the latter assets last longer. Hence, almost entire expenditure on a short-lived asset becomes an expense and is matched against current year's revenue. For attaining following objects, depreciation accounting is a must for every business. Recovery of costs incurred on fixed assets over the useful life so as to keep owner's capital intact. Provision is for replacement cost on the retirement of original assets. To include the depreciation in the cost of production to find out the correct cost of production. To find out correct profit for the year. To find out the correct financial position through balance sheet. There are 2 types of depreciation. Internal depreciation, which occurs for certain inherent normal causes, is known as internal depreciation. Wear and tear. An asset declines on account of continued uses. Example, building, plant, machinery, etc. Such decline depends upon quantum of use of an asset. If a factory works double shift instead of single shift, depreciation on plant and machinery will be doubled. It is obvious that such loss is unavoidable. An asset may be kept in proper working conditions through repairs for the time being, but it cannot be done so permanently. At one time, the asset will become unfit for repairs, when it will no longer be suitable. Depletion. Some assets decline in value proportionate to the quantum of production. Example, mines, quarry, etc. With the raising of coal, etc. from coal mine, the total deposit reduces gradually and after some time it will be fully exhausted. Then its value will be nil. External depreciation. Depreciation caused by some external reasons is called external depreciation. Need for provision of depreciation. The need for provision for depreciation is ascertained of true profit or loss. Depreciation is a loss, so unless it is considered like all other expenses and losses, true profit or loss cannot be ascertained. In other words, depreciation must be considered in order to find out true profit or loss of a business. Ascertainment of true cost of production. Goods is produced with the help of plant and machinery, which incurs depreciation in the process of production. This depreciation must be considered as a part of the cost of production of goods. Otherwise, the cost of production would be shown less than the true cost. Sale price is normally fixed on the basis of cost of production. So if the cost of production is shown less by ignoring depreciation, the sale price will also be fixed at a low level, resulting in loss to the business. True valuation of assets. Value of assets gradually decreases on account of depreciation. If depreciation is not taken into account, the value of asset will be shown in the books at a figure higher than its true value, and hence the true financial position of the business will not be disclosed through balance sheet. Replacement of assets. After some time, an asset will be completely exhausted on account of use. Moving on to next, let's explore the objectives of depreciation. Depreciation is a reduction value or lost usefulness or expired utility or a permanent fall in the value of fixed assets arising through wear and tear from the utility of those assets in business, and includes authorization of assets whose useful life is predetermined. Accounting procedure or process of converting the cost of fixed assets to expense is known as depreciation. It determines and presents the financial position and results of expectations of a firm. Accounting process of converting intangible assets to expenses is called amortization. Main objectives of providing depreciation are to calculate profits, show the asset at its reasonable value, to maintain the original monetary investment of the asset intact and have some incidental advantages, provide for the replacement of an asset, and finally to have tax advantage. Depreciation may happen due to two reasons: internal and external reasons. Internal may be wear and tear, lack of proper maintenance, change in production format, restriction of production, reduction to demand of the product produced by the asset, technical progress, and depletion and unused of the same time. External reasons may be due to obsolescence, which is induced by new inventions, improvement, and loss of demand due to change in fashion and efflux of time. Steps in measurement of depreciation include reduction of total depreciation, spreading it over the economic life of the asset. Depreciation depends on following factors: total cost of asset, which includes the invoice cost, less any cash discount, plus all costs essential to bring the usable condition. Estimated useful service life or economic life and its estimated residual value. Residual value is an estimated sale value of the asset at the end of its life to the business. Estimated residual value should be estimated after deducting the disposal and removal cost. Accumulated depreciation. The cumulative depreciation of an asset up to a single point in its life. Regardless of the method used to calculate it, the depreciation of an asset during a single period is added to the previous period's accumulated depreciation to get the current accumulated depreciation. An asset's carrying value on the balance sheet is the difference between its purchase price and accumulated depreciation. Reduction in accumulated depreciation. The balance in the account accumulated depreciation will be reduced when an asset that has been depreciated is removed. Some accounting textbooks state that the cost of an expenditure that extends the useful life of an asset should be debited to the accumulated depreciation account instead of the asset account. Such an entry will also reduce the credit balance in the accumulated depreciation account. Reduction of accumulated depreciation slabs will allow to add cost to a building for major renovations or improvements, but it will not keep these costs separate. Students, we shall now discuss the factors affecting depreciation. The cost of property with a useful life of 1 year or more and used in a trade or business or held for the production of income is recovered by allowing an annual deduction called depreciation. Depreciable property includes buildings, machineries, furniture, equipment, appliances, vehicles, and any cost for additions or improvements to the rental property. However, the value of land is not depreciable, so the cost of clearing, grading, planting, or other land improvements are also not depreciable. Depreciation allows the taxpayers to deduct some of the cost of the property each year on their tax returns. Taxpayers should claim the correct amount of depreciation every year. Taxpayers who do not claim the depreciation they are entitled to must still reduce their basis in the property by the amount of depreciation that they could have deducted. The important factors which should be considered for determining the amount of depreciation are cost of assets, estimated scrap, estimated useful life, legal provisions, cost of assets. An important distinction is made in accounting between current assets and fixed assets. Current assets are those that form part of the circulating capital of a business. They are replaced frequently or converted into cash during the course of trading. The most common current assets are stocks, trade, debtors, and cash. A fixed asset is an asset of a business intended for continuing use rather than a short-term, temporary asset such as stocks. Fixed assets must be classified in a company's balance sheet as intangible, tangible, or investments. Examples of intangible assets should include goodwill, patents, and trademarks. Examples of tangible fixed assets include land and buildings, plant and machinery, fixtures and fittings, motor vehicles, and IT equipment. The benefits that a business obtains from a fixed asset extend over several years. Estimated scrap value. The worth of a physical asset's individual components when the asset itself is deemed no longer usable. The individual components, known as scrap, are worth something if they can be put to other uses. Sometimes scrap materials can be used as is, other times they must be processed before they can be reused. An item's scrap value is determined by the supply and demand for the materials it can be broken down into. Scrap value refers to the value estimated to be realized after the expiry of the useful working life of the asset. This is also known as residual value or salvage value. Depreciation should be determined after deducting the estimated scrap value from the cost of asset. Estimated useful life. In accordance with one of the more important of the basic accounting conventions, the matching principle, the cost of property, plant and equipment are allocated through depreciation to the periods that will have benefited from the use of the assets. Whatever method of depreciation is chosen, it must result in the systematic and rational allocation of the depreciable amount of the asset. Initial cost less residual value over the asset's expected useful life. Useful life is the period over which an asset is expected to be available for use by any entity, or the number of production or similar units expected to be obtained from the asset by an entity. The useful life of an intangible asset that arises from contractual or other legal rights shall not exceed the period of the contractual or other legal rights, but may be shorter depending on the period over which the entity expects to use the asset. If the contractual or other legal rights are conveyed for a limited term that can be renewed, the useful life of the intangible asset shall include the renewal period only if there is evidence to support renewal by the entity without significant cost. Did you know? In respect of financial years falling after 28 December 1960, depreciation not provided for arrears must first be deducted before paying dividend out of profits of the year for which dividend is to be paid. Accounting treatment including provision for depreciation accounting. Provision of depreciation account is the account of provision of depreciation. First of all, we should understand provision of depreciation. Provision of depreciation is the collected value of all depreciation. With making of this account, we are not credited depreciation in asset account, but transfer every year depreciation to provision of depreciation account. Every year we adopt this procedure, and when assets are sold, we will transfer sold assets total depreciation to credit side of asset account for calculating correct profit or loss on fixed on asset. This provision uses any method of calculating depreciation. Fixed asset is made on its original cost, and every year depreciation is not transferred to fixed asset account. Provision of depreciation account is conglomerated value of all depreciation. Entry of depreciation will change also. Let's move on to the next topic, methods of depreciation. Straight line method depreciates cost evenly throughout the useful life of the fixed asset. Straight line depreciation is calculated as depreciation per annum equals to cost minus residual value or useful life, where cost includes the initial and any subsequent capital expenditure. Residual value is the estimated scrap value at the end of the useful life of the asset. As the residual value is expected to be recovered at the end of an asset's useful life, there is no need to charge the portion of cost equal the residual value. Useful life is the estimated time period an asset is expected to be used from the time it is available for use to the time of its disposal or termination of use. Useful life is normally calculated in units of years, but it may be calculated based on an alternative basis. Useful life of an oil extraction company may, for example, be the estimated oil reserves. It first calculates the depreciable base, cost less salvage, before dividing it by number of years, life of machine, to arrive at annual rate of depreciation. The straight line method is the most straightforward method of asset value depreciation.
Depreciation is the systematic allocation of depreciable amount of an asset over its useful life. I know, that's a whole lot of words. Does that make any sense to you? Let's go through this in simpler terms. We all know what plant, property, and equipment are. Buildings, vehicles, machinery. Basically assets which will be controlled by your business beyond the next 12 months, which helps to generate income. Now, let's use the example of a motel. Items that would depreciate in value, namely the plant, property, and equipment, for this motel could include the motel building itself, room furniture, cleaning equipment, and so on. What happens is that for every year an asset is being used by the business, it also loses its future economic benefit. Take note though, as much as land is considered a plant, property, and equipment, it does not depreciate in value. In fact, Sometimes it actually increases in value over time. Of course, as each asset loses its economic benefits, it causes the business to lose money. This would mean that depreciation is an expense. The type of expense, however, is determined by the asset itself. Depreciation can either be a distribution cost or an administrative expense. In case you've forgotten, distribution costs are expenses dealing with things like promotion, delivery, and storage of a business service and inventory, and administrative expenses are expenses incurred from everyday operations of the business. Going back to our motel's example of plant, property, and equipment, we can take the building and obviously categorize that as being an administrative expense, whereas things like furniture and cleaning equipment would be classified as a distribution cost. So now we know what depreciation is and the types of expenses we can categorize it into. But how do we calculate depreciation? A common and simple method used is called the straight line method. There are two ways to calculate straight line depreciation, and each is dependent on the information you are provided with. The first method is when you have the cost of the item and the rate of depreciation. And the second is when you know the cost of the items, the expected life of the item, and the item's value after its useful life. Back to the motel example, let's say that we know that the motel building was bought for $180,000. Every year its value depreciates at a rate of 4%. What we would do is take that historical cost of $180,000 and multiply that by 4% to get a yearly depreciation amount of $7,200. Of course, since it's a building, this $7,200 would be recorded as an administrative expense. How about if we knew that the motel furniture costed $20,000, which was planned to be kept for 6 years? How would you find the yearly depreciation amount if you knew the value of the furniture will be $2,000 after 6 years? We would take the historical cost of $20,000 and minus it by the expected residual value of $2,000 and divide that by the estimated life of 6 years. From that, we would get $3,000 for the depreciation amount. Don't forget, furniture isn't an administrative expense. It's a distribution cost. So now you should know what depreciation is. It is the systematic allocation of depreciable amount of an asset over its useful life.
Now in the end, let us summarize what we have learned in this lecture. Depreciation is an allocation of capital expenditures over the estimated revenue producing period of a long-term asset. This is required due to the batching principle. Depreciation is determined by acquisition cost, useful life, depreciation rate, and estimated salvage value. Depreciation does not involve the cash account. Only the purchase and disposal of assets involve cash account. Depreciation is the process of computing expense from allocating the cost of plant and equipment over the expected useful. Use the following example to calculate depreciation expense. When plant assets acquired during the middle of a year or month, depreciation is calculated for the fraction of the year the assets owned. Accumulated depreciation represents the sum of all depreciation expenses on the firm's fixed assets, yet it only represents the accumulated depreciation of the firm's existing assets. Assets that have retired are deleted from the balance sheet along with the associated accumulated depreciation.